ladies and gentlemen. Rasool Mohammad is my name. I'm the president and CEO of Select Sands. And like Gwen said, the amount of sand pumped in a well has increased dramatically, and that's going to be the theme of my presentation. Our company is called Select Sand, appropriately named. We trade on the Toronto Venture Exchange and about to start trading on the OTCQX, which is one level lower than the NASDAQ. Disclaimer, forward-looking statements. Goldman Sachs calls it the highest growth among all of oil services subsector, and that's the frac sand. You can see that some companies, Simmons and others, are talking about this particular mesh size, 40, 70, and 100 mesh, being in short supply. That's the finer mesh sand that Gwen was referring to, is what we are mining right now in Arkansas. We kind of took a shortcut route to the production. Currently, we're in the midst of an acquisition, which was supposed to be $42 million US, and we're doing that for $5 million US. We've fully funded to do that. That should start closing in about a month and a half time. And then the average amount of sand per well has gone up from 2,000 tons to 4,000 tons per well. That's short ton. That's about 20 rail cars to 40 rail cars. However, there's been examples in Bakken, Haynesville, Permian, and Marcellus, anywhere from 135 rail cars to 270 rail cars being pumped in one single well. Our valuation, we trade somewhere around 2.5 times for 2018 forecast EBITDAs. Our peers, 4 of them, Emerge Energy Services, High Crush, Fairmont Central, and US Silica, are trading anywhere 8.5 to 9.5 times of their 2018 multiples of EBITDA. This is every single investment bank out there is talking about demand growth. The peak in 2014 was 54 million tons, which is 108 billion pounds. Every single analyst out there is talking about surpassing that demand in 2017. Just an overview of our facility. We've got a quarry at the bottom of the slide, and then we are just in the midst of an acquisition of Ozark Premium Sand, which is shown on the slide at the right at the top right corner. That's a plant we're acquiring right now. You can see the Union Pacific rail line running just adjacent to our property. The bottom part is our quarry. This is fully permitted. We started taking product from here and doing toll manufacturing at this plant up there for about a year time. And right now, like I said, we're just in the midst of acquiring this business, Ozark Premium Sand, which has 600,000 tons of year capacity, 7,000 tons of dry storage, customer list, and inventory for the price of $5 million, as opposed to the capex of $42 million that was forecast by Tetra Tech. This kind of tells the story, the whole story of where we are. Industrial minerals are about location, about where you are, how closer you are to your customer. And as you can see, we're about 400-mile trucking radius to a bunch of the shale plays, including the Fayetteville, the Haynesville, Scoop and Stack, and we can also truck to the largest shale basin, Permian, on a UP rail. Our advantage is proximity to the shale basins. Here is a slide up by Simmons and Company showing various cost structure. Our price would be somewhere around 83 at the highest end and 78 at the lowest end after we acquire the completion. Here is a picture of what's happening right now. When we started on this project in 2014, right around here, the industry average was around 5 million pounds, which is about 2,500 tons. EOG, which is the leader, was using 8 million pounds, which is about 4,000 tons per well. Fast forward to 2016, industry average is about 8 million pounds, which is about 4,000 tons, which is about 40 cars. EOG, which is the leader, share leader, is about 15 million pounds, which is 7,500 tons per well. And all of that demand increase, like Gwen was talking about, that shifted from coarser mesh sand about 40% to the finer mesh sand is what we produce right here. 80% of the completion in the United States is done with the special type of sand is what we produce. It's the 40-1700 mesh, very high purity, 99% SiO2. The closest thing to this type of sand would be diamonds. This is by Credit Suisse. They just did an IPO of another company called Smart Sand. But anyway, here it shows you the northern mines in Wisconsin and Minnesota. Their capacity utilization is about 37%. And that's because it's a function of geology. A third of their deposit are finer mesh, and they can only sell a third of it, as opposed to the regional mines, which we are. That's about 73% capacity utilization. And there is a next chart I'll be talking about what the capacity utilization would look like for regional mines if all the demands go to the regional sand mines, or what would it look like if we keep the current ratio. The slide at the bottom shows what the demand looked like in 2014. It was 108 billion pounds, 54 million tons. Right now, 31 million tons. That's a little bit conservative. We're looking at about 40 million tons run rate for 2016, and we'll be looking 55 and 73 million tons for 2017, 2018, respectively, obviously surpassing the 2014 54 million tons of demand. And all of that increase in demand is for the finer mesh, high purity sand that's from regional mines. This is the chart that I like the most. If you look at the northern white, which is Wisconsin, Minnesota, versus regional mines, which is where we are, the capacity utilization, if all the demand comes to these regional mines, you're looking at 134.7% capacity utilization for the regional sand mines. We fit in this category right here. And this table is from Credit Suisse. Jim Wickland did this table. If you keep the current ratio, you're looking at 98% capacity utilization for this type of mines where we are mining. So in either cases, you're sold out. And that's why the prices are going up right now for this type of frac sand. We're very proud of our team. Our number one asset is our team. I've surrounded myself with very strong individuals who have a diverse background. Our chairman has been a business partner with billionaire Carl Icahn. I've also hired the Martin Marietta industry veteran, which is a Fortune 500 company. He's our chief operating officer, all the way to US Silica's industrial sales guy who's been working with them for 16 years. And we're using his expertise and skills to sell into the industrial market. How are we doing on time? Okay. This is our forecast EBITDA. If we're running a 600,000 ton run rate, we're looking at anywhere from $12 million US to $30 million US. That's at the current run rate of our plant. If we increase our capacity to 1.5 million tons, which we are fully funded right now, to do that, we're looking at about $30 million all the way up to $65 million US EBITDA forecast. Our balance sheet, we got no debt. We just closed on $16.45 million financing last Friday, which was subscribed by most institutions and funds out of the US. All our warrants are in money. We're generating small cash flow by selling into the industrial market. Post Ozark Premium Sand acquisition, which will be closing in about a month and a half time, we're looking at about $13.5 million US in the treasury, decent working capital to have. The sustainable attributes are that we're a tier 1 product, we're closer to the market, we can operate year round compared to the Wisconsin mines. And this is our chart, what's looking like. This was fairly flat till right around August time when Credit Suisse and Goldman Sachs and everybody started talking about the shortage of this type of sand. and they started doing an IPO of Smart Sand. They did that for $135 million, closed it about 2 weeks ago. People realized how undervalued we are. We're currently sitting at around $85 million market cap. Stock is trading around 92 cents.